All right, we're talking about asset location. And yes, this is a topic I've hit on a lot. If you want the definitive source, go to whitecoatinvestor.com/asset-location. And it will talk about all of these principles, okay? We are talking about portfolio design here. And the important thing with portfolio design is that you start at the top, right? You set your goals and you choose what accounts you're going to use to reach that goal. Typically for some things, it's very simple. If it's a health goal, you're probably using an HSA. If it's a college savings goal, you're probably using a 529. But if it's retirement, you probably have 5 or 6 different accounts that you're using toward that goal. Once you've chosen those accounts, you choose your desired asset allocation. And then you choose the individual investments to go into to fulfill that asset allocation. You're choosing funds now. And then you're trying to decide where you put each of those investments inside those accounts. So this is like step 5, the tax-efficient fund placement or the asset location. That's what we're talking about here. And there's a few principles you should be aware of here. But the first thing overall, remember that this is not a problem for lots of people, right? If you only have a taxable account or almost your entire portfolio is a taxable account, well, everything's going in the taxable account. Very easy. Likewise, if you have all your money in a Roth IRA, like you're a resident or something, obviously everything's going in there, right? If you have space in a Roth IRA, you're going to put the investments there. That's great. They grow tax protected. If all your accounts are tax protected, that's great. You don't have to deal with what do I stick in taxable. It's only for people that have some of their retirement money in a taxable account and some of their money in a tax protected account that this becomes an issue. Okay, so keep that in mind, right? Initially, there have been times in my life where my portfolio was 100% tax protected. And so I didn't have to figure out what went in taxable. I didn't have anything in taxable. And obviously, if you can put everything in a tax protected account, that's better, right? You wouldn't pass up an investment in a Roth IRA in order to invest something in a taxable account. Now, there's a few things that you're just not going to put in a tax protected account, like municipal bonds, or you can't put savings bonds in there, for instance. But for the most part, if you're given the choice between a Roth IRA and a 403b or whatever on one side and a taxable account on the other, of course you're going to put it in the tax protected account. That's a good thing. All right, so keep that in mind. All right, assuming you've got a blend of accounts and you've got to put something in taxable, here are the principles to keep in mind. Number 1, the higher the expected return, the more likely that the asset should be in a tax-protected account. What you're trying to do here is grow the ratio of tax-protected to taxable. So that would emphasize that whatever you think is going to have a high return should be in that 403b and that Roth IRA, et cetera. Okay, so that's principle number 1. Principle number 2, the lower the tax efficiency, the more likely the asset should be in a tax-protected account. So this is mostly what our questioner is talking about tax inefficient investments. Tips tend to be pretty tax inefficient. I mean, you can get taxes on tips for income you didn't even receive. This phantom income, for example, I've got some tips now in my taxable account because almost everything's in my taxable account now for me. But I've got these tips in my taxable account that I had like $1,700 last year of taxable income sent to me on a 1099 OID, original issue discount or whatever I think it's called. And I owe tax on that $1,700 or $1,800, but I didn't actually get the income. I don't get the income until, I sell that tips or it matures. And so that's lame, right? Phantom taxes. That's a great reason to keep tips in a tax protected account if you can. It's usually one of the last asset classes that you move out of tax protected accounts into a taxable account. Likewise, high, returning, but tax inefficient investments, think like debt real estate funds, REITs in some respects, although they're a little more tax efficient now than they used to be. That stuff tends to do well in a tax protected account as well. It tends to be one of the last things that you move out. Now, obviously, if you have two stock funds, one has a higher yield than the other one. Both expect similar returns, but one of them is putting out more income. It's a value stock fund or something. You're going to try to keep that one preferentially in the tax protected account. So for most people, the way this works out is the first couple of things they move out into a taxable account is, a total stock market fund, a total international stock market fund. If they have a municipal bond fund, those are the sorts of things that tend to move first. And the things that tend to move later, anything actively managed, bonds tend to move relatively late out of your tax protected accounts. Tips, certainly, REITs, certainly, those sorts of investments are the ones that you tend to move to taxable last when you're forced to. All right, principle number 3. The more likely you are to avoid paying capital gains taxes, the more likely you should put capital gain assets in taxable. Let me go over that one more time. The more likely you are to avoid paying capital gains taxes, the more likely you should put capital gain assets in taxable. What's a capital gain asset? Well, think about like a total stock market fund, right? This is going to be, most of the return is capital gains. It's not income from that fund. It's very tax efficient. And if you are somebody like me that donates a lot of money to charity and you donate appreciated shares instead of cash, or you plan to leave those assets to your heirs where they'll get a step up in basis, i.e., you are likely to avoid paying capital gains taxes, that is a great asset to have in a taxable account. There are things even more tax efficient than, a total stock market fund. For example, cryptocurrency, right? Now, I don't know if it's a good investment. I don't know if you'll actually have a positive return, but if you're convinced that you will, it's very tax efficient. You basically don't pay taxes on it until you sell it. And so if you leave it in there for 50 years, or you leave it in there and leave it to your heirs, right? This is super tax efficient. And so that's a good place for it. Even gold, it gets taxed as a collectible when you sell it, but if you don't sell it, there's no income from it. So it's a capital gain asset. Taxable can be a good place to have that. All right, principle number 4. The more volatile the investment, the more likely it is better in a taxable account. And the reason why is because it gives you opportunities to tax loss harvest it. And especially if you're not paying capital gains taxes because you're donating to charity or saving, appreciated assets for your heirs, then you get the losses and never have to deal with the gains. And so that can be a great thing to have in a taxable account. Comparatively, obviously, if you can put it in tax protected, do it. But if you got to put something in taxable, that can be a good asset there. Principle number 5, place high expected return assets into tax-free accounts, but recognizing that you are taking on additional risk. All right. So this is the Roth versus tax deferred question, right? What do I put in my Roth? Well, a lot of people say, put the thing with the highest expected return in the Roth. So you increase your ratio of Roth to tax deferred. Well, that's probably not the worst advice, but recognize that all you're doing is taking on more risk. The best way to think about a tax deferred account mentally, the way to account for this is to, think of it as a tax-free account, i.e. part of that is like a Roth account. And the other half is an account you're investing on behalf of the government. And if you think of it that way, you'll make the right decisions. Okay? And so it doesn't really matter if you're putting your assets in a into a tax deferred account or a tax free account. Just recognize that if you're putting in a tax deferred account, you have to put more in there because after tax, it's less money than the tax free account is. Okay, so that means if you're putting stuff into the tax-free account, the Roth account, because you think it's going to be, better, that it's going to grow faster, so on and so forth, you recognize that's probably true, but it's just because you're taking on more risk. Your ratio of money in that asset class is greater, because if you look at it from an after-tax basis, you have more there now because you put it in the tax-free account. All right, principle number 6, if you have a required minimum distribution problem, which most people don't have, but if you actually do have a required minimum distribution problem, increase your tax-free to tax-deferred ratio. And the way you can do that is typically with Roth conversions. All right, so that is, basically the advice. the principles you should keep in mind. Now, some people don't like principles. They don't want to apply principles. They just want to be told what to do. Okay. All right, here we go. I'm just going to tell you what to do now. It's in accordance with those principles, but some people just want to be told what to do. So here's what to do. If you're going to invest in muni bonds, do it in a taxable account. The add interest is federal and sometimes state tax-free. If you have an investment with a high expected return that is very tax efficient, like a hard money loan fund earning 11%, for instance, that is likely worth moving it into a tax protected account, even if you end up paying some fees or cost or hassle to do so. Number 3, put your bonds in your tax deferred accounts. Recognize this isn't a free lunch. It's not necessarily the right thing to do at very low interest rates, but even when you're wrong, it doesn't matter much. If you have to invest in a taxable account, the types of assets you want in there include equity real estate, municipal bonds, total market, stock index funds. If you're taxable, the tax protected ratio gets so large that you have to find another asset class to move into taxable. Congratulations, you're going to be very rich. Quit worrying about stuff like this. Max out your retirement accounts. Consider doing Roth conversions. REITs and mutual funds that invest in REITs probably belong in a tax protected account, even if they would qualify for the 199A deduction, because that income is taxed at ordinary income tax rates. I mean, some of it comes out as protected by depreciation. It comes back as return of principal, but the actual taxable income is taxed at ordinary income tax rates. And don't bother doing anything else. It's just as likely to be wrong as right. And even if you're right, it's not going to make that big of a difference. Just worry about getting the big things right. If you're having to decide whether to put your, large value fund or your small value fund into taxable next, don't kid yourself. That doesn't matter that much.